Before we dive in, it is critical to understand that this presentation is for informational and educational purposes only. I am not a financial advisor, mortgage broker, or attorney, and the information provided in this video does not constitute financial, legal, or professional advice. The mortgage landscape is complex and varies by state and individual circumstances. You should always consult with qualified professionals before making any financial decisions. The single biggest financial transaction of your life will likely be buying a house. And it all hinges on one document. A document that the average American signs without truly understanding it. A document that legally obligates them to pay hundreds of thousands, sometimes millions, of dollars over the next 30 years. This document is the mortgage. And misunderstanding it is the most expensive mistake you will ever make. Think about it. The median home price in the United States is hovering around $400,000. With a standard 30-year mortgage, the total interest you pay could easily eclipse $200,000, $300,000, even $400,000. That's an entire second house worth of money, paid directly to the bank, all for the privilege of borrowing. And yet, we spend more time researching which flat-screen TV to buy than we do understanding the mechanics of the debt that will dominate our financial lives for decades. We see the paperwork, our eyes glaze over at terms like escrow, amortization, ARM, points, and pity. And we just sign on the dotted line, trusting that it's all standard. We put our faith in the system, hoping we're not getting a bad deal. This video is your insurance policy against that hope. This is the guide you were never given. Our mission here is simple: to transform you from a nervous homebuyer into a confident, educated consumer. By the end of this presentation, you will not just know what a mortgage is. You will understand how it works from the inside out. You will learn the language of the lenders so you can walk into a bank and negotiate from a position of power, not fear. You will understand precisely where every single dollar of your monthly payment is going. You will learn the difference between the types of loans so you can choose the one that's right for your life, not the one that makes your loan officer the biggest commission. This knowledge will not only give you peace of mind, but it could also save you tens of thousands of dollars over the life of your loan. We are going to strip away all the confusing jargon and replace it with simple, powerful concepts that will stick with you forever. So let's start with the most fundamental question of all, the one most people get wrong from the very beginning. What is a mortgage? If you said, "It's the loan I get from the bank to buy a house," you're about 50% right, and it's the other 50% that truly matters. A mortgage is not actually the money. The money is the loan. The mortgage is something else entirely. It's a legal document. It's a security instrument. Think of it as the bank's collateral. It's the agreement that says, if I don't pay back the loan, the bank has the legal right to take my house. That's it. It's the or else clause in your home buying story. When you get a home loan, you are actually signing two separate, critically important documents. First, there's the promissory note. This is the loan. This is your promise to pay. It's a glorified IOU between you and the lender. It spells out all the details of the money. How much you're borrowing, the principal, the interest rate you'll pay, the total number of payments, the amount of each payment, and the dates those payments are due. It's a straightforward contract of debt. If you were borrowing money from a friend to buy a car, you might write up a simple promissory note. It is your personal promise to repay the debt. But for a house, a promise isn't enough. We're talking about hundreds of thousands of dollars. The bank needs more than your word, they need security. And that's where the second document comes in, the mortgage. Or depending on your state, it might be called a deed of trust. For our purposes, they do the same job. This document is what connects the loan, the promissory note, to the property. It's the legal instrument that gets recorded in your county's land records, creating what's called a lien against your property's title. A lien is just a legal claim. It's a big, red flag on your property's title that tells the entire world, hey, this person owes the bank a lot of money, and this house is the collateral. This lien is what gives the lender the right to foreclose, to force the sale of your home, to recover their money if you stop making payments. The mortgage document is the teeth behind the promissory note's promise. So let's recap this crucial foundation. The promissory note is the I promise to pay. The mortgage is the and if I don't, you can take my house. You need both. One creates the debt, the other secures the debt with your property. This distinction is vital because it helps you understand the two different levels of commitment you're making. You're not just taking on debt. You're pledging your home as the ultimate guarantee. Now that we know what a mortgage is, let's talk about who is involved. It seems simple, right? There's you, the borrower, and the bank, the lender. But once again, the reality is a little more complex, and understanding this hidden layer is key to understanding the whole system. First, there's you, the borrower or the mortgager. You're the one seeking the loan to purchase the property. Your role is to provide a massive amount of personal and financial information, pay stubs, tax returns, bank statements, credit history, to prove you are a trustworthy and reliable person to lend a huge sum of money to. They call this proving your creditworthiness. Second, there's the lender or the mortgagee. This is the institution, usually a bank, credit union, or a dedicated mortgage company, that provides the actual funds for the loan. They are the ones who assess your application, a process called underwriting, to determine if you're a good risk. They set the interest rate and the terms of the loan based on your financial profile and the current market conditions. For the first few weeks or months, you'll be dealing directly with them. But here's the twist that almost no one outside the industry understands. Your original lender, the friendly local bank or the online company you applied with, they usually don't keep your loan. In the vast majority of cases, shortly after you close on your house, your lender sells your loan on what's called the secondary mortgage market. This brings us to the third and most powerful player in this game, the investor. Think about it. If a single bank had to keep every 30-year mortgage it ever issued on its own books, it would run out of money to lend very, very quickly. Its capital would be tied up for decades. The system wouldn't work. To solve this, a massive secondary market was created where lenders can bundle up mortgages and sell them as investments. And the biggest buyers in this market are two giant, government-sponsored enterprises you've probably heard of, but may not understand: Fannie Mae and Freddie Mac. These aren't direct lenders. You can't walk into a Fannie Mae office and ask for a mortgage. Their job is to buy mortgages from the primary lenders, the banks and mortgage companies you deal with. Why do they do this? It injects a constant flow of fresh cash back into the system. Your bank lends you $300,000. They then sell your loan to Fannie Mae for $300,000. Suddenly, the bank has its money back and can now go lend it to another homebuyer. This is what keeps the mortgage market liquid and allows millions of Americans to get home loans. So, while you might have gotten your loan from Bank of America or Rocket Mortgage, the ultimate owner of your debt is very likely an investor like Fannie Mae. This is why mortgage guidelines are so strict and standardized. Lenders aren't just lending based on their own rules. They're lending based on the rules set by the investors who will eventually buy the loan. If a loan doesn't meet Fannie Mae's criteria, the lender won't be able to sell it, and they'll be stuck with it. These are called conforming loans because they conform to the standards set by these massive investors. You might also see a fourth entity appear: the loan servicer. Sometimes, the company that sold your loan will continue to manage it for a fee. Other times, the investor will hire a completely different company to be the loan servicer. This is the company you actually send your monthly payments to. They manage the account, handle your escrow for taxes and insurance, and deal with customer service. This is why you might get a letter a few months after buying your house saying your loan has been transferred, and you now need to make payments to a company you've never heard of. The loan wasn't changed, it was just sold, and the new owner hired a different company to collect your checks. Understanding this chain, from borrower to lender to investor, with a servicer managing the day-to-day, is the first major step to demystifying the entire process. You're not just in a simple two-way relationship with your local bank. You're part of a massive interconnected financial ecosystem. And knowing the players is the first step to playing the game wisely. So you know the players. Now, how do you make your opening move? How do you walk into this massive, complex game and prove you're a serious contender? It all starts with a conversation, but not all conversations are created equal. You've probably heard two terms thrown around: pre-qualification and pre-approval. They sound similar, maybe even interchangeable. But in the world of mortgages, they are as different as a first date and a marriage proposal. Getting pre-qualified is the first date. It's casual, low commitment, and based almost entirely on trust. You call a lender or fill out a quick online form. You tell them your income, you tell them your debts, you tell them about your savings. Based on this self-reported information, they'll give you a ballpark figure of what you might be able to borrow. It's a nice conversation, it gives you a vague idea, but that's it. It's like telling a car salesman you can afford the convertible. They'll smile and nod, but they are not handing you the keys. A pre-qualification letter carries almost no weight with a home seller, because there's no proof. It's just your word. Pre-approval, that's the proposal. This is where you get serious. You're not just talking anymore. You're providing evidence. You hand over the treasure map to your financial life. Pay stubs, W-2s, tax returns, bank statements, investment account details. You're giving the lender permission to pull your full credit report and scrutinize your history. An actual human underwriter, a financial detective, really is going to comb through every detail. They will verify your income, analyze your debts, and judge your creditworthiness. If you pass this financial gauntlet, the lender will issue a pre-approval letter. This isn't a ballpark guess. This is a conditional commitment to lend you a specific amount of money. Now, when you walk up to that car salesman with a pre-approval letter, you're not just a window shopper. You're a buyer with a certified check in your pocket. They don't just hand you the keys for a test drive. They start drawing up the paperwork. In a competitive housing market, a pre-approval letter is your golden ticket. It tells the seller you are a serious, vetted buyer who is ready to close the deal. An offer from someone with a pre-approval will almost always beat an offer from someone with just a pre-qualification, even if the price is the same. It's the single most powerful tool you have before you even start looking at houses. So what exactly is that underwriter, that financial detective, looking for when they're digging through your life? It's not as mysterious as it seems. They are trying to answer one fundamental question for the bank. If we give this person hundreds of thousands of dollars, what is the probability we will get it back with interest? To answer that, they use a framework, a kind of scorecard. And it generally comes down to what industry insiders call the 4 C's: capacity, capital, credit, and collateral. Let's break them down. First, and arguably most important, is capacity. This is your ability to handle the monthly mortgage payment. It's not about how rich you are. It's about your cash flow. The key metric here is something called your debt-to-income ratio, or DTI. This might be the most important number in your financial life that you've never paid attention to. The formula is simple. You take all your monthly debt payments, student loans, car payments, credit card minimums, and the proposed new mortgage payment, and you divide it by your gross monthly income, the money you make before taxes. So if you have $2,000 in total monthly debts and you make $6,000 a month, your DTI is 33%. Lenders have very specific thresholds for DTI. Generally, they want to see that number below 43%. Why? Because data shows that once your debt obligations start eating up more than 43% of your income, the risk of you defaulting on one of those loans skyrockets. Your capacity is too strained. A low DTI tells the lender you have breathing room. You have the capacity to handle your obligations, even if life throws you a curveball. The second C is capital. This is the cash you bring to the table. It's your skin in the game. This primarily means your down payment. The more money you put down, the less the bank has to lend you, which immediately reduces their risk. A 20% down payment is the traditional gold standard. If you put down 20% on a $500,000 house, that's $100,000 of your own money. From the bank's perspective, you are highly motivated not to lose that $100,000, which means you're highly motivated to make your mortgage payments. If you put down less than 20%, the lender sees you as a higher risk. To offset that risk, they will almost always require you to pay for private mortgage insurance, or PMI. Think of PMI as an insurance policy that protects the lender in case you default. The cruel irony is that it's an insurance policy for them, but you're the one who has to pay the premium every single month. Capital also includes your cash reserves, the money you'll have left in the bank after you pay your down payment and closing costs. Lenders want to see a safety net. They want to know that if your air conditioner breaks a month after you move in, you won't have to choose between fixing it and paying your mortgage. The third C is credit. This is your financial report card. It's a history of your past behavior with borrowed money. Your FICO score is a numerical summary of that report card. It tells the lender, does this person pay their bills on time? How much debt do they currently carry? How long have they been managing credit? A high credit score, typically anything in the mid-700s and above, signals that you are a responsible, reliable borrower. It unlocks the best interest rates, saving you tens of thousands of dollars over the life of the loan. A lower score doesn't necessarily mean you won't get a loan, but it signals higher risk to the lender. To compensate for that risk, they will charge you a higher interest rate. Your credit history is a story you've been writing for years, and the lender is going to read every single page. Finally, the fourth C is collateral. This is the house itself. In a mortgage agreement, the house is the security for the loan. If for whatever reason you stop making payments, the lender has the legal right to foreclose and take possession of the property to recoup their losses. It's the ultimate safety net for them, but they need to make sure their safety net is actually worth what you're paying for it. That's where the appraisal comes in. The lender will hire an independent appraiser to assess the home's value. If you agree to buy a house for $500,000, but the appraiser determines it's only worth $480,000, the bank will only lend you money based on that lower value. The appraisal isn't for you. It's to protect the bank and ensure their collateral is solid. Capacity, capital, credit, collateral. These four pillars create the entire foundation of a lender's decision. They paint a holistic picture of you as a borrower. It's not just about one number. You could have a huge income, but if your credit is terrible, you're a risk. You could have perfect credit, but if you have no down payment and a high DTI, you're a risk. The underwriter's job is to look at all four C's together to build a risk profile. Your job as the homebuyer is to make that profile as strong as possible before you ever submit that application. By understanding this scorecard, you're no longer just blindly handing over documents. You're strategically presenting your case. You're showing the gatekeepers that you understand the rules of the game and that you are a safe, reliable bet. So let's say you do it. You get your finances in order, you strengthen your four C's, you endure the scrutiny, and you emerge victorious with that coveted pre-approval letter. You've proven you're a worthy player. But this is where the game gets even more complex. Getting approved is just passing the first level. Now you have to choose your weapon for the levels ahead. And this choice, this single decision, will dictate the terms of your financial life for the next 30 years. You'll be presented with a menu of options with names like fixed rate, ARM, FHA, conventional. One path offers stability and predictability, a safe, well-lit road through a dark forest. Another offers a lower cost to start, but a path filled with hidden traps and potential dangers down the line. Choosing the wrong one can cost you tens, even hundreds of thousands of dollars more than necessary. So, how do you know which path is right for you? It all comes down to one question. What do you value more? Predictability or potential savings? Security or flexibility? Every mortgage in the United States falls into one of two giant families, each with a completely different philosophy on how to handle your money. Think of them as two rival kingdoms. In one corner, you have the kingdom of fixed-rate mortgages. This is the old guard, the establishment. It's built on a foundation of stone and certainty. Its motto is, the rate you get today is the rate you have forever. And in the other corner, you have the kingdom of adjustable-rate mortgages, or ARMs. This is the newer, more dynamic kingdom. It's built on the shifting sands of the market. Its motto is, why lock in today's rate when tomorrow's might be lower? 90% of American homebuyers choose to live in the kingdom of fixed rate. So let's start there. It's the bedrock of the entire system. A fixed-rate mortgage is exactly what it sounds like. If you lock in a rate of 6.5%, that is your rate for the entire life of the loan, whether that's 15 years or 30 years. It doesn't matter if the economy soars and interest rates shoot up to 15%. Your rate stays at 6.5%. It also doesn't matter if the economy tanks and rates drop to 2%. Your rate, still 6.5%. It is the single most predictable, stable, and frankly boring financial product you will ever encounter. And in the world of homeownership, boring is beautiful. Boring means you know exactly what your principal and interest payment will be this month, next year, and 10 years from now. It means you can budget with absolute certainty. It means you will never wake up to a letter from your lender saying your payment is suddenly jumping by $500 a month. This predictability is the number one reason people choose it. But even within this stable kingdom, there are two main paths you can walk: the superhighway that almost everyone takes, and the express lane. These are the 30-year fixed and the 15-year fixed mortgages. Let's talk about the 30-year fixed. This is the F-150 of the mortgage world. It's the most popular option in America by a country mile. Why? Because it offers the lowest possible monthly payment. By stretching the loan out over 3 decades, the bank makes each individual payment smaller and more manageable. Let's imagine you're buying a $400,000 house. With a 20% down payment, you're borrowing $320,000. At a 6.5% interest rate on a 30-year mortgage, your monthly principal and interest payment would be about $2,022. That number is your financial anchor for the next 360 months. It will not change. This affordability is what opens the door to homeownership for millions of people. It makes the dream possible. It also gives you breathing room. With a lower monthly payment, you have more cash free every month for other things. Investing in your 401k, saving for your kids' college, or just handling life's unexpected emergencies without financial stress. But this affordability comes at a staggering cost. A hidden cost that many people don't truly grasp until it's too late. Over those 30 years on that $320,000 loan, you will pay the bank approximately $408,000 in interest alone. That's right. You will pay more in interest than the original amount you borrowed. You'll end up paying back a total of $728,000 for that $320,000 loan. It's the price of certainty, the price of a lower monthly payment. This is where the express lane comes in, the 15-year fixed mortgage. This is for the person who wants to get to the destination of being debt-free as fast as humanly possible. Using the exact same scenario, a $320,000 loan at 6.5% interest, the 15-year mortgage completely changes the math. Your monthly payment would jump to about $2,789. That's almost $770 more per month than the 30-year option. That's a significant chunk of change. For many people, that's a deal breaker right there. It's just not affordable. But if you can afford it, the reward is mind-blowing. Over the life of the 15-year loan, your total interest paid would be about $182,000. Let me say that again. $182,000 on the 15-year loan versus $408,000 on the 30-year loan. By choosing the 15-year path, you would save over $226,000 in interest. You would own your home free and clear 15 years sooner. You would build wealth at a dramatically faster rate. So why doesn't everyone do this? Because it requires sacrifice. It means a tighter budget, less disposable income, and less money for other investments. It's a trade-off between short-term cash flow and long-term wealth. The 30-year mortgage is like a marathon. You pace yourself, it's a long, slow grind, but you're more likely to finish without collapsing. The 15-year is a sprint. It's intense, it takes a ton of energy up front, but you cross the finish line in record time. Now, there's a critical secret about how these loans work that you need to understand. It's called amortization. It sounds complicated, but the idea is simple. Think of your monthly mortgage payment as a seesaw. On one side is interest, and on the other side is principal, the actual money you borrowed. In the early years of your loan, especially a 30-year loan, that seesaw is tipped heavily towards interest. Your $2,022 payment might be sending $1,700 straight to the bank as interest, and only $322 is actually going towards paying down your loan balance. You are barely making a dent in what you owe. It's a brutal reality. For the first decade, you are essentially renting money from the bank. But with every single payment you make, the seesaw shifts, ever so slightly. The next month, a tiny bit more goes to principal and a tiny bit less goes to interest. Over years and decades, the seesaw slowly tips the other way. In the final years of your loan, your payment is almost all principal with just a few dollars going to interest. This is amortization, and the 15-year mortgage puts this process on hyperspeed. From day one, the seesaw is much more balanced, allowing you to attack the principal and build equity, your actual ownership stake in the home, at a blistering pace. So the kingdom of fixed rate offers you a choice: the slow, steady, affordable marathon of the 30-year, or the fast, expensive, wealth-building sprint of the 15-year. For most first-time buyers, the 30-year is the only realistic entry point. For someone selling their first home and moving to their second, using their equity as a huge down payment, the 15-year becomes a powerful tool to be completely debt-free by the time their kids are in college. This is the fundamental choice you have to make. But this is all based on a traditional view of lending. This assumes you fit into a neat little box. It assumes you have a great credit score and a big pile of cash saved up for a 20% down payment. But what if you don't? What if you're a veteran? What if you want to buy a home in a rural area? What if your credit is just okay? Does that mean you're locked out of the game entirely? Not even close. In fact, that's where a completely different set of rules, a set of secret passages and specialized tools, comes into play. These are the government-backed loans, and they change everything. And they change everything by fundamentally altering the relationship between you, the lender, and risk. Think of it this way. A conventional loan is like trying to get into an exclusive, high-stakes poker game. You walk up to the table and the dealer, the bank, looks you over. They check your stack of chips, which is your down payment. They check your playing history, your credit score. If your stack isn't big enough or your reputation isn't flawless, they just shake their head and say, "Sorry, this table is for high rollers only." You're turned away. A government-backed loan is like walking up to that same table. But this time you have a powerful casino boss standing right behind you. This boss, Uncle Sam, puts a hand on your shoulder and says to the dealer, "They're with me. Let them play. And if they lose their chips and can't cover their debts, I'll make it right. I'll cover the loss." Suddenly, the dealer's entire attitude changes. The risk they were so worried about? It's gone. Or at least, it's significantly reduced. They're no longer betting on just you. They're betting on you plus the full faith and credit of the United States government. This makes them far more willing to deal you in. Even if your personal stack of chips is a little small, or your playing history has a few bumps. This insurance is the core principle behind the three main types of government-backed loans. The FHA loan, the VA loan, and the USDA loan. They are the secret passages, the keys that unlock doors that would otherwise be sealed shut. And the most common, the one that has opened the door to homeownership for millions of Americans since the Great Depression, is the FHA loan. The FHA, or Federal Housing Administration, doesn't actually lend you any money. This is a huge misconception. You still go to a regular bank, a credit union, or a mortgage company like Chase or Rocket Mortgage. What the FHA does is provide the insurance we just talked about. They are the casino boss who vouches for you. It was created in 1934 for a simple reason. The housing market had completely collapsed. Banks were terrified to lend and people were terrified to buy. The government stepped in and said, "We need to get this engine running again." So they created a system to absorb the risk and give lenders the confidence to start writing mortgages again. And the way they did this created two incredible superpowers for buyers. Superpower number one is the legendary low down payment. We just spent time talking about the myth of the 20% down payment and how you can get a conventional loan for as little as 3% or 5% down. Well, the FHA takes it a step further. The minimum down payment for an FHA loan is just 3.5%. Let's put that into real numbers. On that same $400,000 house, 3.5% is just $14,000. $14,000. This is, for many people, the single most important number in their home buying journey. It transforms the goal of saving for a down payment from a monumental, decade-long quest into something that is genuinely achievable, sometimes in just a year or two. And get this, the FHA is also incredibly flexible about where that money comes from. It doesn't all have to be your own hard-earned savings. It can be a gift from a family member. This one rule alone has made millions of dreams a reality. Superpower number two is credit flexibility. This is where the FHA really shines as the loan of second chances. Conventional loans are picky. They want to see pristine credit, usually a score of 720, 740, or higher to get the best rates. But the FHA understands that life happens. Maybe you had a medical bill go to collections, or you were late on a credit card during a tough time, or you just haven't had credit long enough to build a sky-high score. The FHA's guidelines are far more forgiving. While lenders still have their own standards, it's possible to get approved for an FHA loan with a credit score as low as 580. For someone with a score in the 600s, who is responsible and has a steady income but a less-than-perfect credit history, the FHA isn't just an option. It's often the only option. It's the difference between continuing to rent for years while you try to repair your credit, or starting to build equity for your family right now. So, a low down payment and flexible credit requirements. It sounds perfect, right? It sounds like the ultimate cheat code. And for many people, it is. But this is the real world, and there is no such thing as a free lunch. The government is providing this incredible insurance to the lender, and you, the borrower, are the one who has to pay for it. This payment is called Mortgage Insurance Premium, or MIP. And on an FHA loan, it's a mandatory, non-negotiable part of the deal. Comes in two parts. First, there's an upfront mortgage insurance premium, or UFMIP. This is a one-time fee, currently 1.75% of the loan amount. So on a $386,000 loan for that $400,000 house, that's an extra $6,755. Now, you don't usually have to bring that to the closing table in cash. Most people just roll it into their total loan balance. So you're borrowing and paying interest on it for the life of the loan. But the second part is the real kicker. It's the annual MIP. Despite its name, it's paid monthly as part of your total mortgage payment. It's a recurring fee, and this is the crucial detail you have to understand. For most FHA borrowers, anyone who puts down less than 10%, you pay this monthly mortgage insurance for the entire life of the loan. It never goes away. If you have a 30-year mortgage, you are paying that extra fee every single month for 30 years, unless you sell the house or refinance into a different type of loan. This is fundamentally different from the PMI on a conventional loan, which, as you'll recall, automatically drops off once you reach about 22% equity in your home. With an FHA loan, you can pay your balance down for 15 years, build up 50% equity, and you will still be paying that monthly insurance premium. It's the price of admission. It's the cost of using the government's VIP pass to get into the game. There are a couple of other catches too. FHA loans have stricter property standards. Because the government is insuring the loan, they want to make sure the house you're buying is safe, sound, and livable from day one. An appraiser will conduct an FHA-specific inspection, looking for things like peeling paint, broken windows, or a faulty roof. This is actually a good thing for you as a buyer. It's a free safety check. But if you're trying to buy a fixer-upper, a home that needs a lot of work, it might not pass the FHA appraisal, which can kill the deal. Finally, there are FHA loan limits. You can't use an FHA loan to buy $1 million mansion. The government sets a maximum loan amount that varies by county, designed to align with the typical cost of a modest home in that specific area. So the FHA loan is a powerful tool, but it's a trade-off. You get an incredibly accessible path to homeownership with a low down payment and flexible credit, but you pay for it with mortgage insurance that could last for the entire loan term. For many first-time buyers, it's a trade they are more than willing to make. It's the key that gets them out of the rent race and into a home of their own, allowing them to start building wealth. They can always refinance into a conventional loan later on, once they've built up enough equity and their credit score has improved, to get rid of that pesky MIP. It's the perfect solution for someone with a steady job, but not a lot of savings. But what if you meet a very specific set of criteria? What if you're a military service member, a veteran, or a surviving spouse? And what if I told you there's a way to get a house with a down payment that makes the FHA's 3.5% look huge? A way to get into a home with quite literally $0 down. And what if there was another secret key, designed specifically for people who want to live in more rural or suburban areas, that also requires zero down payment? These aren't just hypotheticals. These are the VA and USDA loans, and they operate on a level of benefit so high, they make even the FHA look ordinary. Let's start with the VA loan because it's less of a loan program and more of a national promise. It's a thank you codified into the financial system for those who have served in the United States military. If you're an active duty service member, a veteran, or an eligible surviving spouse, this is a benefit you have earned through sacrifice. And its primary feature is so powerful it fundamentally changes the home buying equation. A 0% down payment. Not 3.5% like an FHA loan. Not 3, 5, or 20% like a conventional loan. 0. You can, in theory, buy a home with absolutely no money down. This single benefit catapults people into homeownership years, sometimes decades, before they would have otherwise been able to save up a down payment. But that's just the opening act. The real long-term powerhouse of the VA loan is its second major benefit. No monthly private mortgage insurance, or PMI. Remember how with FHA loans and low down payment conventional loans, you have to pay that extra insurance fee every single month? That fee that doesn't build your equity, doesn't pay down your principal, and only protects the lender? With a VA loan, it's gone. It doesn't exist. Let's put that into perspective. On a $400,000 home, PMI could easily cost you between $200 and $400 a month. That's thousands of dollars a year and tens of thousands over the life of the loan that you are just lighting on fire. With a VA loan, that money stays in your pocket. You can use it to invest, to save, to furnish your new home, or to simply have a lower, more manageable monthly payment. This isn't a small perk. It's a monumental financial advantage. Now you might be thinking, what's the catch? There's always a catch. And with VA loans, it's called the VA funding fee. This is a one-time fee paid to the VA to help keep the program running for future generations of service members, with no burden on taxpayers. The fee is a percentage of the loan amount, and it varies based on your service, your down payment amount, and whether it's your first time using the benefit. For a first-time user with zero down, it's typically around 2.3% of the loan. On that same $400,000 loan, that's about $9,200. That sounds like a lot, but here's the key. In most cases, you don't have to pay this out of pocket. It can be rolled right into your total mortgage amount and paid off over the 30-year term. And when you compare that one-time finance fee to the soul-crushing, never-ending monthly payments of PMI on other loans, the VA loan wins by a landslide. Even better, some veterans, including those receiving VA disability compensation, are completely exempt from paying the funding fee at all. Add in the fact that VA loans often have some of the most competitive interest rates on the market because the government guarantee reduces the lender's risk, and you have what is arguably the single best mortgage product in existence. But its power is reserved for a select few who have earned it. So what about everyone else? What if you haven't served, but the idea of a zero down payment loan sounds like the only way you'll ever own a home? Is there another door? For millions of Americans, the answer is a surprising yes. But this door isn't opened by who you are. It's opened by where you want to live. This is the USDA loan. When you hear USDA, United States Department of Agriculture, you probably think of farms, cattle, and endless fields of corn. And that's the biggest misconception about this program. The USDA Rural Development Loan isn't for buying a farm. It's a program designed to encourage people to buy homes and build lives in less populated parts of the country, strengthening those local economies. And just like the VA loan, its headline feature is a 0% down payment, 100% financing. It is another direct pathway to homeownership without needing to spend years saving tens of thousands of dollars. Of course, this program has its own unique set of rules. There are two big hurdles you have to clear. The first is location. The property you want to buy must be in an eligible rural area as defined by the USDA. Now, your mind might jump to a cabin in the woods miles from civilization, but the USDA's definition of rural is incredibly broad. It covers 97% of the landmass of the United States. This includes countless small towns, suburban communities, and the outskirts of many major cities. You would be shocked to see how many desirable growing areas qualify for these loans. The USDA has an easy-to-use eligibility map on their website where you can type in an address and see instantly if it qualifies. For many people, their dream home is already in a USDA-eligible zone, and they have no idea this incredible benefit is waiting for them. The second hurdle is income. Unlike VA or FHA loans, USDA loans have income limits. You can't make too much money. This is because the program is specifically designed to help low to moderate income families. The exact income limit varies by county and the number of people in your household, but it's designed to be reasonable for the local cost of living. The goal is to help working-class families achieve the dream of homeownership, not to subsidize purchases for high earners. So what's the catch with the USDA loan? It has its own form of mortgage insurance, which they call a guarantee fee. It works a lot like the FHA system, but it's often cheaper. There's a one-time upfront fee, currently 1% of the loan amount, which, like the VA funding fee, can be rolled into the mortgage. And then there's an annual fee, currently 0.35% of the remaining principal balance, which is broken up and paid monthly. While it's not as good as the VA's no PMI deal, that 0.35% is significantly lower than the 0.85% or more you'd pay on an FHA loan for the entire life of the loan. It makes the USDA loan a far more affordable long-term option for those who qualify. So now we have three powerful government-backed tools on the table. Let's put them head-to-head. In the battle of the down payment, the VA and USDA are the undisputed champions at 0%, making homeownership accessible to those without large savings. The FHA at 3.5% is a distant but respectable third place. In the war against mortgage insurance, the VA loan is the clear victor. No monthly PMI period. The one-time funding fee is a small price to pay for that freedom. The USDA comes in second, with its relatively low annual fee that makes it a financially savvy choice. The FHA loan, with its expensive and often permanent monthly mortgage insurance premium, comes in last. It's the price you pay for its more lenient credit and location requirements. And finally, in the contest of eligibility, it's a three-way tie, because they serve completely different people. The VA loan is for our honored military community. The USDA loan is for moderate-income families building lives in rural and suburban America. And the FHA loan is the great equalizer, the widely accessible option for millions of people who don't fit into the other two categories, but still have the dream of putting a key in their own front door. These government-backed loans are not subprime or lesser options. They are strategic programs, each designed with a specific mission: to reward service, to build communities, and to provide a stable foundation for American families. They are the ladders that have allowed generations of people to climb into the middle class through homeownership. But this is only half the story. With all these incredible government benefits, zero down, lower insurance, more flexible credit, why would anyone on earth ever choose a different path? Why is the most common type of mortgage in America none of these? This seems like a trick question, but the answer reveals the hidden power and the hidden dangers of the conventional loan. Because when you step away from government backing, you enter a world where the rules are written by the private market. And for the right borrower in the right situation, the rewards can be even greater. The conventional loan is the bedrock of the American mortgage market. It's the default option, the standard by which all others are measured. But unlike FHA or VA loans, there's no government agency insuring your lender against loss if you default. It's just you, the lender, and a contract. This creates a fascinating dynamic of risk and reward. The lender is taking a bigger gamble on you personally, and because of that, they demand more. They scrutinize you more closely, and they have stricter rules. But if you can meet their standards, they open up a world of flexibility and options that government-backed loans simply can't match. The first and most famous hurdle is the down payment. You've heard the magic number your whole life. 20%. Put 20% down. Save up 20%. But why? Why that specific number? It's not arbitrary. It's a calculated risk assessment. From a lender's perspective, a borrower who puts down 20% of the home's value has significant skin in the game. You're not just a renter with a mortgage, you're a co-investor. You have a huge financial incentive to make your payments because if you don't, you stand to lose a massive amount of your own cash. That 20% cushion also protects the lender. If you default and they have to foreclose, the home's value could have dropped. That 20% equity you put in acts as a buffer, making it much more likely the bank can sell the home and recover the full loan amount. But here's the secret most first-time buyers don't realize. You don't always need 20% for a conventional loan. You can often get one with as little as 5% or even 3% down in some special programs. This sounds amazing, right? It's the fast track to homeownership, but it comes with a massive, expensive catch. A hidden cost that can drain thousands of dollars from your wallet for years. It's called private mortgage insurance, or PMI, and this is one of the most misunderstood concepts in real estate. PMI is insurance, yes, but it does not protect you. Let me say that again because it's critical. PMI does not protect you in any way. If you lose your job and can't make your payments, PMI will not help you. PMI is insurance that you are forced to buy to protect your lender. You are paying a monthly premium for an insurance policy where the bank is the sole beneficiary. It's a fee for the privilege of having a low down payment. Let's put some numbers on this. Imagine a $400,000 house. A 20% down payment is $80,000. If you have that, great. No PMI. But let's say you only have 10% or $40,000. The lender sees you as a higher risk. So they approve your loan, but they tack on PMI. The cost varies, but a typical rate is around 0.5% of the loan amount per year. Your loan is $360,000. 0.5% of that is $1,800 a year, which you'll pay as an extra $150 tacked onto your mortgage payment every single month. $150 that builds you zero equity. $150 that doesn't go towards your principal or your interest. It just vanishes into the pocket of an insurance company to protect the bank that's already charging you interest. Over 5 years, that's $9,000 gone. This is the hidden danger of the low down payment conventional loan. It's a wealth-draining mechanism disguised as a helping hand. So how do you escape it? This is where the greater reward comes in. The moment you escape PMI is a moment of financial liberation. There are two primary ways to do it. First, you can pay down your mortgage until your loan balance is 80% of the home's original purchase price. At that point, you can formally request the lender to cancel PMI. By law, they are required to automatically terminate it once you reach 78%. The second and often faster way is through appreciation. Let's say you bought that $400,000 house, and 2 years later, the market is hot and your home is now appraised at $500,000. Your loan balance might still be around $355,000, but now that loan is only 71% of your home's new value. You have a loan-to-value ratio of 71%. You've crossed the 20% equity threshold not just by paying, but by your home's value growing. You can contact your lender, pay for a new appraisal to prove the value, and get your PMI removed, saving you that $150 every single month going forward. This is a powerful strategy for building wealth. But the world of conventional loans gets even more complex. It's split into two distinct universes: the world of conforming loans and the world of jumbo loans. To understand this, you need to know about two of the most important, yet invisible players in the entire mortgage industry: Fannie Mae and Freddie Mac. These are not people. They are giant government-sponsored corporations. Their job is to buy mortgages from the lenders who originate them. Think about it. If your local bank lends you $300,000, that's $300,000 of their cash that's now tied up for 30 years. To get that cash back so they can make more loans, they bundle your mortgage up with others and sell it on the secondary market to Fannie Mae or Freddie Mac. This is what keeps the entire mortgage system liquid and flowing. But Fannie and Freddie have rules. They will only buy loans that conform to their standards. This means the borrower has to have a certain credit score, a certain debt-to-income ratio, and most importantly, the loan amount has to be under a specific limit. This is called the conforming loan limit. For most of the United States in 2024, that limit is $766,550. In high-cost areas like parts of California or New York City, it can be over $1 million. Any loan below this limit is a conforming loan. It's the easiest type for a lender to make because they have a guaranteed buyer for it in Fannie and Freddie. But what happens if you need to borrow more than that limit? What if you're buying a $1.5 million home? You now enter the world of the non-conforming or jumbo loan. And this is where the rules change completely. A jumbo loan is too large for Fannie or Freddie to buy. This means the lender who makes the loan is stuck with it. They have to keep it on their own books, a strategy called portfolio lending, or find a private investor to buy it. The risk for the bank just skyrocketed. They are on the hook for the entire amount for the entire term. And you can guess what that means for you, the borrower. The requirements become ironclad. Forget about 3 or 5% down. For a jumbo loan, lenders will almost always require a minimum of 20% down, and often 25 or even 30%. Your credit score can't just be good, it needs to be excellent, often 740 or higher. Your debt-to-income ratio has to be lower and more conservative. And they'll want to see a massive pile of cash in your bank account after you close. They call this post-closing liquidity, or reserves. They want to know that if you lose your job, you have enough cash to keep making your mortgage payments for 6 months, or even a full year. Sounds intimidating, and it is. It's a high-stakes game. But here is the final counterintuitive reward of the conventional loan. Because jumbo loans are for wealthy, highly qualified borrowers, banks compete fiercely for their business. This competition can sometimes drive the interest rates for jumbo loans below the rates for smaller, conforming loans. It's a strange paradox. The bigger, riskier loan for the bank can sometimes come with a better interest rate for the borrower who is strong enough to qualify for it. So the conventional loan is a spectrum. On one end, you have the accessible but potentially costly option of a low down payment with its PMI trap. In the middle, you have the gold standard conforming loan that fuels the majority of the market. And at the far end, you have the exclusive, demanding, but potentially rewarding world of the jumbo loan. You're navigating a private marketplace, where your financial strength dictates the terms you're offered. Now that we've dissected the types of loans, the government-backed and the conventional, we have to talk about the structure of these loans. Because choosing FHA or conventional is just the first decision. The next choice you make could have an even bigger impact on your financial life for decades to come. It's the epic battle between security and speed, a choice that pits the slow and steady marathon runner against the all-out sprinter. I'm talking about the 30-year fixed versus the 15-year fixed. And lurking in the shadows is a third, seductive, and often dangerous option that has brought financial ruin to millions, yet still tempts borrowers with its deceptively low introductory offer. The adjustable rate mortgage. The adjustable rate mortgage. It's the chameleon of the home loan world. The deal with a devilishly attractive smile. Unlike the predictable, steadfast nature of a fixed-rate mortgage, the ARM is a shapeshifter. Its defining characteristic, the very thing that gives it its name, is that the interest rate is not locked in for the life of the loan. It changes. It adjusts. And this is where the seduction begins. Lenders offer ARMs with an initial low teaser rate, a rate that is often significantly lower than what you could get on a 30-year fixed mortgage at that same moment. This initial period is fixed typically for 3, 5, 7, or even 10 years. This is the honeymoon phase. Your monthly payment is beautifully, wonderfully low. You can afford more house. The numbers on the pre-approval letter look fantastic. You feel like you've cracked the code, like you found a loophole that all those other suckers paying the higher fixed rate missed. Let's look at the most common type, the 5-to-1 ARM. The name itself is a code. The first number, the 5, tells you how many years your introductory fixed rate period lasts. So, for 5 glorious years, your interest rate is locked in place just like a fixed rate mortgage. The second number, the 1, tells you how often the rate can change after the initial period is over. In this case, it can adjust once every 1 year. So a 7-to-1 ARM has a 7-year fixed period, then adjusts annually. A 5/6 ARM has a 5-year fixed period, then adjusts every 6 months. During those first 5 years of a 5-to-1 ARM, everything is perfect. Your payment is predictable and, more importantly, affordable. You're building equity, you're living in your home, And you're saving hundreds of dollars a month compared to your friend who took out the 30-year fixed. But as the calendar pages turn and the end of year 5 approaches, a storm is gathering on the horizon. The honeymoon is about to end. And when it does, your interest rate is set adrift on the volatile seas of the global economy. So how is your new rate determined? It's not arbitrary. The bank can't just decide to triple your rate because they feel like it. Your new rate is calculated using a simple formula: index plus margin. Let's break that down. First, the index. The index is a benchmark interest rate that reflects general market conditions. It's the part of the equation the bank doesn't control. Think of it as the wholesale cost of money. It goes up and down with the economy, inflation, and the decisions of the Federal Reserve. A common index used today is the SOFR, or the Secured Overnight Financing Rate. You don't need to know the gritty details, you just need to know this. It's a number published daily that your bank has no control over. It is the tide and your mortgage is the boat. Second, the margin. This is the bank's part. The margin is a fixed number of percentage points that the lender adds to the index. Think of it as their guaranteed profit, their markup on the wholesale cost of money. This margin is set in stone in your loan agreement. It will never change for the entire life of your loan. If your margin is 2.75%, it will be 2.75% on day 1 and 2.75% 20 years from now. So when your 5-year fixed period is over, the bank takes the current value of the index. Let's say the SOFR is at 4%, and they add your fixed margin. Let's say it's 2.75%. Your new interest rate becomes 6.75%, and your monthly payment is recalculated based on this new, higher rate. And this will happen every single year for the next 25 years. If the index goes up, your rate goes up. If the index goes down, your rate goes down. You are now strapped into a financial roller coaster. Now you might be thinking, that sounds terrifying. What's to stop my rate from going to 20%? And that's where the final piece of the ARM puzzle comes in, the caps. These are safety features designed to protect you from catastrophic, overnight payment shock. There are 3 main types of caps. First is the initial adjustment cap. This limits how much the rate can increase the very first time it adjusts. A common initial cap is 5%. So if your starting rate was 3%, the highest your rate could jump to after the first 5 years is 8%, even if the index plus margin formula says it should be 9%. Second is the subsequent adjustment cap. This limits how much the rate can increase in all the following years. This is typically lower, often 2%. So, after that first big adjustment, your rate can never go up or down by more than 2 percentage points in any single year. Finally, there's the lifetime cap. This is the absolute ceiling your interest rate can never ever exceed, no matter what happens in the economy. This might be 5% or 6% over your initial rate. So if you started at 3%, your lifetime cap might be 8% or 9%. It's your ultimate safety net. Let's put this all together with a real-world and potentially painful example. Imagine you buy a $500,000 house. You get a 5-to-1 ARM with a beautiful starting rate of 4.5%. Your initial monthly principal and interest payment is about $2,533. Life is good. For 5 years, you pay that same amount. But during those 5 years, the economy changes. Inflation kicks in, and the index your loan is tied to skyrockets from 2% to 6%. Your margin is 2.75%. At the end of year 5, your adjustment is due. The bank calculates your new rate. 6%, the index, plus 2.75%, your margin, equals 8.75%. Let's say your loan has a 5% initial cap. Your rate can't jump all the way to 8.75%. But it can jump the full 5 percentage points from 4.5% to a new, much higher rate of 9.5% if the lifetime cap allows it. But let's assume the initial cap is the binding constraint, and the new rate becomes 8.75%. Your new monthly payment on that same loan just jumped from $2,533 to roughly $3,840. That's an increase of over $1,300 every single month. This is what's known as payment shock. And this is the exact mechanism that led to financial ruin for millions of people in the run-up to the 2008 financial crisis. They were sold on the dream of the low initial payment, with little understanding of the nightmare that could follow when the rate reset. So, is an ARM always a terrible idea? A ticking time bomb? Not necessarily. But it is a specialized tool, not a one-size-fits-all solution. An ARM might make sense for a very specific type of borrower. For example, If you know with 100% certainty that you are going to sell the house and move before the initial fixed rate period ends. In that case, you get the benefit of the lower rate and get out before the adjustment risk ever kicks in. Or perhaps you're a high-income earner who expects significant raises in the coming years and can easily absorb a potential payment increase. Or maybe you're a real estate investor who plans to flip the property quickly. For the vast majority of American homeowners, however, who are looking for stability, predictability, and the peace of mind that comes with knowing their housing payment will be the same next month as it will be 20 years from now, the ARM represents a gamble. A gamble that interest rates will stay low. A gamble that your income will go up. A gamble that you'll be able to sell or refinance before the reset. It's a bet against uncertainty. And in the world of personal finance, betting against uncertainty is a very risky game to play. So you've chosen your weapon. The slow and steady 30-year, the aggressive, wealth-building 15-year, or the volatile, high-risk, high-reward ARM. But choosing the loan type is only half the battle. Because your monthly mortgage payment, the number you actually write the check for, isn't just made up of principal and interest. There are two other silent partners in your mortgage, two critical costs that can grow, change, and even surprise you years down the road, completely independent of your interest rate. They are the inescapable duo of taxes and insurance. Let's dissect this duo, starting with the one nobody can escape: property taxes. Think of property taxes as your subscription fee for living in a civilized, functional community. That pristine park down the street? The public schools your kids might attend? The fire truck that shows up if things go sideways, the police officer on patrol, the roads you drive on every single day? They are all funded, in large part, by property taxes collected from homeowners just like you. It's the price of admission to a functioning town or city. Your lender has a vested interest in making sure this subscription fee gets paid. Why? Because if you stop paying your property taxes, the government, be it the county or the city, can place a lien on your home. A tax lien is the ultimate trump card. It takes priority over almost every other debt, including the mortgage. This means the government could potentially foreclose on your home and sell it to get their money back, and your lender would be left with nothing. Your lender will absolutely not let that happen. So, how is this tax actually calculated? It's a two-part formula. The assessed value of your home multiplied by something called the millage rate. First, the assessed value. This is not the same as the market value or the price you paid for the house. The market value is what a buyer is willing to pay. The assessed value is a figure determined by a local government official, the tax assessor, for the specific purpose of calculating your tax bill. They might look at recent sales, the size of your lot, the square footage of your house, and any improvements you've made. In many places, the assessed value is intentionally lower than the market value, sometimes a specific percentage of it. This is important because a higher assessment means a higher tax bill, and you often have the right to appeal your home's assessed value if you believe it's unfairly high. The second part of the equation is the millage rate, or mill rate. This sounds complicated, but the concept is simple. 1 mill is 1/1000th of a dollar, or 1/10th of a cent. A millage rate is the amount of tax you pay for every $1,000 of your home's assessed value. So, if your local millage rate is, say, 25 mills, you pay $25 in tax for every $1,000 of assessed value. Let's run a quick, simple example. Imagine you buy a home, and the local assessor determines its assessed value is $200,000. And let's say the combined millage rate for your city, county, and school district is 30 mills. To find your annual property tax, you take the assessed value, $200,000, divide it by 1,000, which gives you 200. Then you multiply that by the mill rate of 30. So 200 times 30 equals $6,000. That's your annual property tax bill. Now, here is the critical part that trips people up. That $6,000 isn't fixed forever. Your local government can, and often does, change the millage rate. If they need to fund a new school or hire more firefighters, they might raise the rate. And every few years, the assessor will reevaluate your property. As home values in your neighborhood go up, your assessed value will likely go up too. Either one of these changes will cause your tax bill to increase, completely independent of your fixed mortgage rate. This is one of the primary reasons why your total monthly housing payment can creep up over time. So how do you pay it? This is where the lender steps back in with a clever mandatory system called an escrow account. An escrow account is essentially a holding tank, a separate savings account managed by your mortgage servicer. When you make your monthly mortgage payment, it isn't just for principal and interest. The lender also collects an extra amount for your estimated property taxes and your homeowner's insurance. They take your estimated $6,000 annual tax bill, divide it by 12, which is $500, and add that $500 to your monthly payment. They put that money into your escrow account, and when the big property tax bill comes due once or twice a year, they pay it for you on your behalf using the funds you've been setting aside. It's a forced savings plan to ensure the government gets paid, and the lender's investment stays safe. Now for the second silent partner, homeowners insurance. If property taxes protect the government's interest, homeowners insurance protects the lenders. The house is their collateral. It's the physical asset securing that massive loan they gave you. If that house were to burn to the ground in a fire or get wiped out by a tornado, you might walk away from the loan, leaving the lender with a worthless piece of scorched earth. To prevent this, every lender will require you to have homeowners insurance for the life of the loan. This isn't a suggestion. It's a non-negotiable condition of getting a mortgage. This insurance policy is a contract that covers the cost to repair or completely rebuild your home in the event of a disaster. But it covers more than just that. A standard policy typically includes coverage for your personal belongings inside the house. Your furniture, clothes, electronics. Provides liability protection, which is huge. If a guest slips on your icy driveway, breaks their leg, and decides to sue you for medical bills and damages, your liability coverage can save you from financial ruin. It also provides for loss of use, meaning if your home is unlivable while it's being repaired after a covered disaster, the insurance company will pay for your hotel or rental costs. What's crucial to understand is what it doesn't cover. Standard policies almost never cover damage from floods or earthquakes. If you live in an area prone to these events, you will need to buy separate, additional insurance policies. Your lender will know if your home is in a designated flood zone and will require you to purchase flood insurance, adding yet another cost. And just like property taxes, your homeowner's insurance premium is not a fixed, one-time price. Can and very likely will go up. Insurance companies reevaluate their rates all the time. If there's been a string of hailstorms or wildfires in your region, they might deem the area riskier and raise premiums for everyone. As the cost of labor and building materials goes up with inflation, the cost to rebuild your home increases, and so does your premium. If you file a claim, your rates will almost certainly rise. And how do you pay for this? You guessed it, the escrow account. Just like with taxes, the lender takes your annual insurance premium. Let's say it's $1,800 for the year, divides it by 12, which is $150, and adds that to your monthly payment. They put that money into your escrow account alongside the tax money, and when your annual insurance bill is due, they pay it for you. This is where the famous acronym PITI comes from. Your total monthly mortgage payment is made of 4 parts: principal, interest, taxes, and insurance. PITI. The principal and interest are for the bank. The taxes and insurance are for the government and the insurance company, collected by the bank and held in escrow. Once a year, your lender will conduct what's called an escrow analysis. They'll look at what they actually paid for your taxes and insurance versus what they collected from you. If your taxes or insurance premiums went up, your escrow account will have a shortage. To fix this, the lender will do 2 things. They'll often give you the option to pay the shortage in a lump sum, or more commonly, they will increase your monthly mortgage payment for the next year to both cover the new, higher costs and make up for the previous year's shortfall. This is the moment of shock for many new homeowners. The letter from the bank saying their payment is going up by $50, $100, or even more, even though they have a fixed-rate mortgage. The rate on your loan is fixed, but the T and the I are variable, and they are powerful enough to change your entire budget. Understanding this dynamic is one of the most important and most overlooked aspects of owning a home. But PITI isn't always the full story. For millions of homebuyers, there's a 5th letter that gets tacked on, another cost that can feel like you're just lighting money on fire. That 5th letter is M, for mortgage insurance, specifically private mortgage insurance or PMI. And if PITI is the cost of living in your house, PMI is the cost of not having enough money to buy your house in the first place. That sounds harsh, but it's the truth. And it's one of the most misunderstood aspects of a mortgage. Most people think it's insurance for them, that if they lose their job and can't make payments, this insurance will kick in and save them from foreclosure. That is absolutely 100% wrong. PMI does not protect you, protects the bank. You are forced to pay a monthly premium for an insurance policy that only pays out to your lender if you default on your loan. It's like being forced to buy a life insurance policy for your neighbor, with your neighbor as the only beneficiary. You pay the bill, they get the benefit. So why on earth does this exist? It all comes down to one word: risk. Let's go back to the bank's perspective. They're lending you hundreds of thousands of dollars. They see you as an investment, and like any investor, they want to minimize their potential losses. For decades, the industry standard has been that a homebuyer should have a down payment of at least 20%. Why 20%? Because that 20% represents your skin in the game. It's a significant chunk of your own money that you stand to lose if things go wrong. It shows you're serious. But more importantly, it creates a massive financial cushion for the lender. If you buy a $500,000 house and put down 20% or $100,000, your loan is for $400,000. If you stop paying and the bank has to foreclose, the housing market could crash by 10 or even 15%, and they could still sell the house for more than the $400,000 they lent you. They're protected. But what if you only put down 5%? That's just $25,000 on that same $500,000 house. Your loan is for $475,000. Now, if you default and the market has a tiny hiccup, say prices drop just 6%, the house is only worth $470,000. The bank is already underwater. They're guaranteed to lose money. To a lender, a down payment of less than 20% is a flashing red light. It signals a higher risk borrower. So, to offset that risk, they came up with a solution. They said, okay, we'll give you the loan with a small down payment, but on one condition: you have to buy an insurance policy for us. An insurance policy that will cover our losses if you default. And that is PMI. It's the price you pay for not having a 20% down payment. So how much does this privilege cost you? PMI rates typically range from 0.5% to as high as 2% of your total loan amount per year. Let's run the numbers on that $475,000 loan. If your PMI rate is 1%, that's $4,750 a year. Divide that by 12, and you get an extra $395 tacked onto your mortgage payment every single month. That's nearly $400 that isn't paying down your loan, isn't building you equity, isn't paying your taxes or your insurance. It is pure, unadulterated cost. It's a fee for being a higher-risk borrower. Over 5 years, that's nearly $24,000 evaporated into thin air. Now, here's where it gets really important. For millions of people, PMI feels like a life sentence, a permanent tax on their dream of homeownership. But it is not. Getting rid of PMI is one of the biggest financial power-ups you can achieve as a homeowner, and there are specific rules and strategies to make it happen. You need to know these rules. First, there's the law. The Homeowners Protection Act of 1998 gives you rights. Under this law, your lender is legally required to automatically terminate your PMI on the date when your principal balance is scheduled to reach 78% of the original value of your home. The key words there are scheduled and original value. This means if you just make your regular payments as planned, it will eventually go away on its own. But you don't have to wait for that. The law also says you can request to have your PMI canceled once your mortgage balance reaches 80% of the original value. Why would you do this? Because it can happen months or even a year earlier than the automatic 78% cutoff, saving you hundreds or thousands of dollars. You just have to be proactive. You call your lender, you submit a written request, and as long as you have a good payment history, they are required to cancel it. But here is the real secret weapon. The strategy that can save you tens of thousands of dollars and shave years off your PMI payments. Both of those rules are based on the original value of your home. But what if your home is worth more now than when you bought it? What if the market has gone up? This changes everything. Let's go back to our example. You bought a $500,000 house with 5% down. Your loan was $475,000. Your loan-to-value ratio, or LTV, was 95%. You've been paying your mortgage for 3 years. Your loan balance is now down to, let's say, $455,000. Based on the original purchase price, your LTV is now 91%. $455,000/$500,000. You're still a long way from that 80% target. But wait, in those 3 years, your neighborhood has become incredibly popular. Homes are selling like crazy. You suspect your home's value has shot up. So you contact your lender and say, I'd like to request PMI removal based on the current appraised value of my home. The lender will say, okay, but you'll have to pay for a new appraisal to prove it. An appraisal might cost you $500 or $600. You agree. The appraiser comes out and the report comes back. Your home is now valued at $600,000. Now let's recalculate your LTV. Your loan balance is $455,000. Your home's value is $600,000. Your new LTV is 75.8%. You are now well below the 80% threshold. You send the appraisal to your lender and poof, that $395 monthly PMI payment is gone. Forever. That $600 appraisal just saved you nearly $4,750 every single year until you would have otherwise paid the loan down. This single move can be one of the most profitable actions you ever take as a homeowner. So how do you avoid this PMI mess in the first place? The obvious answer is to save up a 20% down payment. But in today's expensive housing market, that can be a monumental, even impossible, task for many first-time buyers. Another strategy is something called a piggyback loan. This is often structured as an October 10th 80 loan. It means you get a primary mortgage for 80% of the home's price. You put 10% down in cash, and you take out a second, smaller loan, the piggyback, for the remaining 10%. Because your main mortgage is at that magic 80% LTV, there's no PMI required. The catch? You now have two separate mortgage payments to make each month, and that second loan often comes with a higher, and sometimes variable, interest rate. It's a trade-off you have to carefully calculate. The world of mortgage insurance is complex, and it doesn't stop with PMI. The rules we've just discussed apply to what are called conventional loans. But there's a whole other universe of government-backed loans like FHA and VA loans, which have their own unique and often more strict forms of mortgage insurance. Understanding the difference isn't just academic. It can mean the difference between paying a fee for a few years or being stuck with it for the entire life of your loan. And that is the final piece of this puzzle we need to put into place. So let's put it into place. Let's talk about private mortgage insurance, or PMI, versus mortgage insurance premium, or MIP. These two acronyms sound similar, but they operate in fundamentally different worlds and can impact your wallet in dramatically different ways. First, let's look at PMI. Private mortgage insurance is what you'll encounter with a conventional loan. That's a loan not backed by a government agency. If you put down less than 20% on a conventional loan, the lender sees you as a slightly higher risk. To offset that risk, they require you to have PMI. This insurance doesn't protect you. It protects the lender in case you default on the loan. It's a fee, typically a percentage of your loan amount, that gets added to your monthly mortgage payment. But here's the beautiful part about PMI. It's temporary. It's designed to go away once your loan-to-value ratio hits 80%. Meaning you've paid down your mortgage balance to 80% of the home's original appraised value. You can request to have your PMI removed. And by law, once your loan balance is scheduled to reach 78% of the original value, the lender must automatically terminate it. So, with a conventional loan and PMI, you're on a clear path to shedding that extra cost. Every extra payment you make towards your principal gets you closer to that 78% finish line, and closer to a lower monthly payment. Now let's cross the street and look at the world of FHA loans and their version of mortgage insurance. MIP, or mortgage insurance premium. This is where things get tricky, and where a lot of first-time homebuyers get caught off guard. FHA loans are fantastic for getting your foot in the door, especially with lower down payments and more flexible credit requirements. But their mortgage insurance works very differently. MIP has two parts. First, there's an upfront mortgage insurance premium, or UFMIP. This is a one-time fee, currently 1.75% of your loan amount. That's typically rolled into your total mortgage balance. You're paying interest on it for the life of the loan. But that's not all. You also have an annual MIP, which is paid monthly as part of your mortgage payment, just like PMI. And here is the critical distinction, the one that can cost you tens of thousands of dollars over time. If you get an FHA loan today and put down less than 10%, you will pay that monthly MIP for the entire life of the loan. It never goes away. 30 years. It doesn't matter if you pay your loan down to 78%, 50%, or even 10%. That MIP payment is your permanent companion until you sell the house, pay off the loan, or, and this is the key, refinance into a different type of loan. If you put down 10% or more, it goes away after 11 years, which is better, but still a very long time compared to conventional PMI. Let's make this real. Imagine two identical families buying identical $300,000 houses. The Smith family uses a conventional loan and puts down 5%. They'll have PMI for a few years, maybe 6 or 7, until they hit that magic 22% equity mark, and then it's gone forever. Their monthly payment drops. The Jones family uses an FHA loan and puts down 5%. They will pay MIP every single month for 30 years. For the first few years, their payments might look similar. But by year 8, the Smiths are celebrating a lower monthly payment, while the Joneses are still paying that extra premium. By year 15, the Smiths have saved thousands. By year 30, the difference is staggering. The Joneses have paid an extra $60, $70, maybe even $80,000 for the privilege of that FHA loan, all because of an insurance premium that never disappeared. So what's the takeaway? It's not that FHA loans are bad. They are an incredible tool that has enabled millions of people to become homeowners. The takeaway is that knowledge is power. If you have an FHA loan, you need a long-term strategy. Your goal should be to build equity as fast as you can, so that you can eventually refinance out of that FHA loan and into a conventional loan, finally shedding that lifetime MIP payment. It's an extra step, but it's a step that can profoundly change your financial future. And with that, we've done it. We've reached the end of our journey. We've taken this massive, intimidating concept, the American mortgage, and we've broken it down piece by piece. We started with the simple dream of a front door and a key. Then we built the foundation: pity, principal, interest, taxes, and insurance, the 4 pillars of your monthly payment. We pulled back the curtain on amortization and saw how those early payments are almost all interest, and how even one small extra payment a year can feel like a superpower, shaving years off your loan. We navigated the treacherous waters of interest rates, distinguishing between the fixed-rate anchor and the adjustable-rate gamble. We explored the entire ecosystem of loan types, from the workhorse conventional loan to the accessible FHA, the honorable VA, and the rural USDA. We walked through the pre-approval process, transforming you from a window shopper into a serious buyer with a golden ticket in hand. We faced the final boss: closing costs, demystifying the mountain of fees that stand between you and the keys. And just now, we dissected the nuances of mortgage insurance, a detail that can mean the difference between temporary cost and a lifelong financial drag. You now know more about how a mortgage works than 95% of the population. You understand the language, you see the mechanics, and you recognize the potential pitfalls before you even step into them. This isn't just academic information. This is a shield. It's a sword. It's a map to navigate one of the biggest financial decisions you will ever make in your life. The goal was never to make you a mortgage broker. The goal was to give you confidence. The confidence to ask the right questions. The confidence to compare loan estimates and know what you're looking at. The confidence to choose the right loan product for your specific situation, not just the one someone pushes on you. Because a mortgage isn't just a loan. It's not just a pile of paperwork and a monthly debit from your bank account. It's the financial engine that powers the American dream of homeownership. It's a tool for building generational wealth, a stable foundation for your family, and a piece of the world that is truly yours. It is complicated, yes. Can be stressful, absolutely. But it is not impossible. It's a system with rules. And now you know those rules. You're no longer on the outside looking in. You're in the driver's seat. So take a deep breath. The next time you hear someone talking about points or escrow or PMI, you won't feel a sense of confusion. You'll feel a sense of recognition. The fog has lifted. You are now equipped. Go forward, build your future, and build your home. You've got this.